Welcome, everyone, to episode number 15 of the Wide Lens podcast. I'm Robert Baharian, and I've got my colleague Matt Rigby here with me today. And we're going to be covering the latest topics in finance and investment markets. We're recording this on Friday, the 6th of May, although the doc says Thursday, the 6th of May. I'm not sure what's going on there, but it definitely is Friday today. And we're going to get straight into Matt's Market Minute.
All right, here we go. So all this info from Yahoo this time around. Okay, so the ASX flat for the last 5 days, down about 3% year to date. The RBA raised rates 0.25 during the week. After the market was up prior to that and then fell, which was interesting.
So hold on, what happened on the market? On the I'm derailing you here. Yep. Market doing nothing on the rate hike day.
It was up in the morning. And
what happened to the bloodbath?
Fell after that.
Fell 0.4%.
Yeah, didn't really do much. Kind of gave up what it had gained. So a little bit of a non-event in the end. So some earnings commentary that has come out in the past week. Companies that disappointed some degree. JB Hi-Fi down about 4%. So no guidance for the next year. I think that was the issue there. Flight Centre down about 4, ARB down about 18, costs and staffing issues were the big issues there. Still great business growing really well, but just expectations missed. Corporate travel down about 4%, Aussie broadband down about 28%, still growing at 30%, but again, some issues there, probably more communication and expectations. AGL battling, something from Cannon Brooks. I don't even know what he's trying to do. And Kogan down about 10%. I think supply issues and cost being the issue there. Some positive commentary though. ANZ, Woolworths, Bapcorp, PointsBet up 10%. They had a really positive quarter, and the NAB. But yeah, just generally it's commentary. Where commentary is not great, stocks are coming off. The NASDAQ last 5 days down about 3%. It was smacked last night, down 5% last night, down 22% year to date. S&P.
It was smacked down 5%, but the day before was up like 5%.
Yeah, it was up. Yeah, 3 or 4 or something. But yeah, it's almost up and down. And what was interesting is it rallied after the Fed's 50 basis point hike. And then it kind of rallied on the back of that. So it's given up what it gained, but down about 3% for the week. S&P down 2.5% for the week, down 13.5% year to date. I don't have the usual positive, negative, all that sort of stuff. The data provider.
What's going on, Refinitiv?
Wasn't.
What's happening?
Give me the shits today, so I couldn't do it. So again, Yahoo. This is based on their kind of expectations or what they're recording. So companies that had beat earnings. Berkshire Hathaway had their meeting last week.
Massive.
Booking, Holding, Airbnb, all both beat. Editas, which is the gene editing company, they're up about 4.8%. They beat. Uber beat, and AMD, the chip maker, they also beat. There were a few that missed, none of note. One that did meet was Starbucks, which was interesting just because of cost pressures and labour and all the rest of it. Emerging markets, the last 5 days, down about 0.5%, year to date, down 12.6%.
It seems to be stabilising around that level, doesn't it?
It does. It's been around that for probably a month now, maybe. I don't know, maybe recency bias there, but it seems to have stabilised. Oil down, up about 4% for the week, up around 44 year to date, now trading at $105, $106. And Bitcoin, interesting, down 3% for the last 5 days, down 23, almost 24% year to date. So that's worse than the NASDAQ, and we haven't seen that for a little while.
What's the NASDAQ number? Down 22. It's about the same.
I'm calling it worse.
Okay.
About 2%.
Slightly.
Bad. 36,500 US is the price.
Oil's not hitting $200 anymore? Has that ship sailed?
I don't know. I think it was Warren Buffett over the weekend saying that the energy, the increase in demand is outstripping the increase in renewables. So fossil fuel demand will continue to be there for quite a period of time. and people aren't drilling as many new wells as what companies aren't drilling as many new wells as they were, and they're getting harder and harder to find bigger wells. So I don't know. You never say never, right? But oil's going to be strong for a while, I think.
Yeah, I don't think it's going to be an overnight thing where that changes and people don't need fossil fuel anymore all of a sudden. I think it'll be
around for a while. So yeah, some oil stocks, I mean, they're still doing really well for the year. So, if you've been in that, you've been in some of the fossil fuel, coal as well has done exceptionally well.
Well, ESG portfolios may not be doing so well on the back of that. And fuel prices are coming down thanks to Scott Morrison's 50% reduction in the fuel levy.
Are they?
Nothing to do with the oil price, just Scott Morrison's oil levy.
I think the petrol companies have banked some of that.
Well, diesel's still sitting at like $2. All right, look, let's get into valuations. We wrote about this last week, whereby we've seen extreme pessimism today, and we're seeing levels that we have not seen since 1992, and it's almost 30 years. I mean, people's pessimism is worse than what it was back in 2020, the GFC. We've never seen this low levels of bullish sentiment in the market since 1992. And with all that's going on at the moment with interest rates and recession talks and so on and so forth, I want to bring this chart up now, which is the S&P 500 price to earnings ratio. This is the analyst earnings expectations over the next 12 months and the price that people are willing to pay for future revenue or earnings. You can see the multiples sitting at 17.7 times. It was getting around the 24, getting close to 25 times just before 2021. And we've seen it go sideways, and we've seen a real decline now where it's basically at the level now as to where it was pre-pandemic in 2019. And to me, it seems like it's more the pessimism now that's driving the decline in valuations rather than the earnings themselves. We'll talk about it a little bit later now.
Yep.
Companies are still reporting quite good earnings, not everybody, and I think we'll talk about that as well later on. The stock market now is on track for the worst year since 2008. We've talked about how much has fallen in the year of 2022. I mentioned valuations are back to where they were pre-pandemic levels, and we can see that in a number of stocks. You look at Amazon, you look at Meta, you look at Netflix, they've got their worst drawdowns that they've had over the last 10 years. Netflix is down 72% from its pre-high from the back end of 2021 in December, and it's fallen 72%. Now, the interesting thing is the stock market is indicating that companies or the economy is going to struggle in the future. Now, the stock market is a forward-looking beast and a forward-looking machine, and whether that's going to happen or not, who knows? Maybe it will, maybe it won't, but the data that's coming out now is not suggesting that the economy is in poor shape. And I just wonder how much of this because if you think back in 2020 during the pandemic and when the stock market rose, the numbers weren't looking good. And I just wonder if the bottom line is that the stock market is not the economy and the economy is not the stock market, and how much we can look into that based on what's going on now. What do you think?
Yeah, look, I think it's interesting. You're right. Earnings have still been pretty good. I mean, more companies beating than missing. It'll be interesting at the end of the earnings season to get those stats, who beat and who didn't. And maybe that's just expectations are lower than reality. I think your point about the stock market being forward-looking is interesting. Typically the stock market's looking 6 to 12 months ahead. So if we go 6 to 12 months from now, where are we? Basically November, December. If you try and forecast, which is almost impossible, but I'm going to do it anyway. Maybe inflation has started to come off because it's rounding much higher numbers, so it's harder to keep it up at that level. The Fed Reserve have maybe done most of the work with interest rates, and therefore the economy is starting to slow, things are cooling off. There's so many factors. Supply chains. I mean, we'll talk about later on. I think, the ships banking up outside of China with their hard lockdowns. I mean, that's going to cause a second round of supply chain issues, which might just cause a second round of inflation. And so we've got all these things, and given all the uncertainty, given the rate and indications at which the Fed are going to raise rates, it's probably not a surprise that the market's coming off. And yeah, it's not the real economy, but at what point does it start to have an impact? The wealth effect, which we've talked about many times before. At some point, if let's say the market falls another 10% from here, so it's 30% down for the year. That's the Nasdaq. Let's say the S&P's down 20-25. My thoughts are that then starts to have an impact on spending. Not that interest rates aren't already having an impact and inflation's not already having an impact, but I think it's just another factor that's influencing.
But that's not out of the realm of possibilities, right? For us to be down 30% by the end of the year.
Not at all.
And in fact, what we're seeing now, and we wrote about this last week, and I think possibly the week before, is that we've seen a decline of 13 or 14% in the stock market. The average drawdown, going back to 1950 or 1980 of the last 30, 40, 50 years, maybe 70 years, is a 14% intra-year drawdown. And so it feels really bad right now what we're going through. But the fact is that we've seen the average drawdown throughout the year is in fact 14%.
Yeah, and it's shit going through it. I mean, no one likes it. And I was chatting to Carlos this morning. He's like, man, market was down. I just feel like I don't want to spend. And I was like, exactly. I mean, that's the wealth effect.
That's the whole point,
right there. And I think the other thing is too that I almost want to say that the Fed Reserve don't care that the market's down. Previously when markets would go through periods like this, they come out and start to talk it up, and they're really not. And if anything, they're doubling down on their kind of forward projections of kind of what to expect for rates. So,
but is the market literally it's down, but is that so much of an issue on the back of such a massive rally over the course of the last 2 years? And we'll talk a little bit about the divergence in companies within the market itself.
Yep.
But is a 12% decline in the market that big of an issue?
It's not if people were able to cast their mind back further than January 1. I think if you showed a graph and said, all right, here's where we are now, here's where we were last year and the year before, people are like, that's okay. That's not so bad. But if you isolate just this year, and that's what everyone's talking about, is this year it's down this year it's down that. It's people forget about the past. And so that's done. It's where are we going now? Oh, it's going to keep falling because it has. So it will,
And I think after the June, July is where we see the year-on-year inflation numbers really max out.
Yeah.
I think once we've gone past that, once we're in the second half of the year, I reckon we'll start to see some level of normalization or inflation rates that don't continue to grow at the high single digits that we're seeing now. I reckon that'll start to fall. I think maybe the interest rates thing will start to have some degree of impact on people's psyche and what they decide to do. And so maybe you're right. Maybe this thing is looking 6 to 12 months down the track, and before you know it, we're in Christmas. Yeah, we're down 15%. I don't see what the big deal is. And interest rates are up to 2% at that point in time, maybe in the US. And we'll talk about this later, but maybe then we have a recession for 6 months, and then we start cutting rates again.
Yeah, and
all that can happen in such a short period of time.
And rates take a while to impact. So the rate rises they've had in the US so far this year, they haven't started to impact the numbers yet. And so they will early next in the second half of this year. So
let's move on to talk about central banks and more close to home.
Yeah, so look, the RBA just can't catch a break at the moment. They're copying it from all sides. Politicians doing their typical bash anyone to make us look good in an election year. Economists coming out left, right and centre saying the Reserve Bank are too slow to move, they're not moving fast enough, they should have moved earlier, so on and so forth. There was this article in the Fin Review, the Reserve Bank must be made accountable for inflation mistakes. So the article, basically they're saying that there's no real oversight or, the Reserve Bank aren't held to account. So they come out and go, right, our inflation target's 2 to 3%. Our stable employment target is whatever it is. But they haven't hit it for so long. So for years they were under, now they're over. So again, they've missed it. And so
who's publishing these articles?
Well, this was some bloke out of the Fin Review. I think it was just an opinion.
Oh, it is an opinion. I've just got up opinion piece, yeah. Peter Tulip.
Yeah, and so initially I was like, come on, man. I mean, if you look back over the last 30 years, relative to other central banks and economies, I think the Reserve Bank have done a pretty good job. However, as I was reading the article more and more, there were a couple of things. I was like, yeah, okay, there isn't. So one point he made that I didn't realise is, so he's saying one partial remedy would be to appoint more monetary policy experts to the RBA board. Most current board members are non-economists who do not have the training to ask the governor, doesn't the research say the opposite to what kind of you're putting out there as policy?
Because the economists get it right all the time, right?
Because they are geniuses. I have never met one that's got it wrong. So, but I think his point was interesting in that, something I've always liked about the RBA board is they've got quite a broad, diversified range of experts inputting policy. So, they've got business owners, major CEOs from major companies in there. They've got, economists in there. Well, maybe not as many as I thought, but, they've got kind of a broad range of inputs. But I think the point was the governors it was implied, or I took it as being implied, a bunch of yes men. And so there's no real open debate about, well, I thought we should have done this and here's why, or I thought we should have cut rates
with the benefit of
why.
hindsight, everyone should have done a whole bunch of things very differently. But how does the Australian Central... First of all, the Australian Central Bank gets praised for all the good work they do. And I don't think you can praise them for all the good work and then criticise them for the bad work they do. I think you need to take it... You got to take the bad with the good. And I just don't think the Reserve Bank controls the frigging global economy.
They don't. But I think the point is that they're sort of left to their own devices, which I agree with to a point. So back in the day, obviously, Keating famously ramped rates up, got it wrong, and we went into recession. And the central bank was part of the government, and now they're supposed to be independent.
Are they? Do you think they are? Because I was going to ask you.
I think they are. I mean, well, they raised rates in an election cycle or election.
What's that got to do with an election?
Well,
what's the global economy?
So if you look historically, the global economy's got nothing to do with it. But historically, when the Reserve Bank was controlled by the government, they would never raise rates as they're trying to get re-elected.
Sure.
That's all my point is.
But isn't the raising of rates a signal of a strengthening economy?
Good, right? Except if you're the opposition, then it's bad. I mean, it's just pure political football. But I think they are. I think they're mostly independent. You don't get... remember Trump really having a crack at Jerome Powell?
Yeah.
You don't get that here. You don't get that overt try and, influence. Maybe it's behind the scenes. I don't know. I think overall they've done a good job, but I think there's always room to improve. There's always room to sort of make, to improve, to tinker, to hold them to account, to have them kind of be scrutinised. I don't think they're above scrutiny. And I think that's basically what the article was getting at. But, economists have been coming out for a little while now saying that they're behind the ball. Inflation hasn't taken off like it has throughout the rest of the world, and most of it is out of the Reserve Bank's control. So I don't, 100%. Rates need to go up a bit, but I don't think we need to be at 3% by the end of this year. I mean, honestly, I think that would push us into a recession if it went that high that quickly.
I'm not sure how much of an immediate impact the RBA raising rates has on the backlog of ships docked and anchored on the ports of Shanghai.
Well, I'm sure they're watching it. Oh shit! The Reserve Bank raised. We've got to get this stuff out.
Look, it's great for headlines. I just don't. And look, to some extent, there's probably some validity to the opinion around the mix of backgrounds and so forth that make up the board. But to just go, I mean, it's easy for every armchair economist to sit there and say, this should have happened or should have done this, all right? Like, it's easy to be the armchair economist, but when you're sitting there making big decisions like that
have real impacts on people's lives. And also, you can say whatever you want as a economist of whatever bank, but no one, 2 weeks' time, no one's going to remember that you said that. So it doesn't matter. But if you say it as a Reserve Bank governor and you
do something about it,
rates, everyone's going to remember that.
And people remember for 30 years.
Yeah, exactly right. So look, I think, there's case for more oversight, more asking questions, but I think for the most part, they've done a pretty damn good job.
I don't disagree with you. They have moved a lot quick. I mean, they were talking about no rate rises for 2023 or 24.
Yeah,
I thought it got before 2023.
Well, I think they wound it back. It was 24, 23, and now they've moved earlier.
But they don't appear to be as stubborn as what commentators have made them appear to be. They are moving. Are they slow? I don't know. We're not going to know what the impact is until after the fact.
12 months.
So everyone's a genius now, but I think we just need to give this time for these things to roll over. And the year-on-year growth in June, July for inflation, I reckon that's going to be telling. I think that will make a bit of a difference.
Yeah, as we get into September, October, it'll be pretty interesting to see what inflation's looking like at that point.
Yeah, Yeah, let's move on.
All right, so moving on and sticking on interest rates. So there was an article, again, in the Fin Review quoting Victor Schvetz. I'm sure I've got that wrong. Sorry, Vic. At Macquarie. So he's Macquarie's global head of strategy. So rates are going up just to come down. So his point was simply that central banks, as we've just said, would be forced into a dramatic backpedal and will be considering cutting rates within 12 months, just as markets expect policy rates to peak.
Yeah.
So basically saying, as you've mentioned a couple of times, you increase rates to cut them because you can't cut from zero.
Victor's listening to the Wide Lens podcast.
He might be.
Big shout out to Victor Schvetz from Macquarie.
one of the dozens of listeners, right? So the whole bunch of really interesting stuff. I won't read it all. If you can get access to it, it's certainly worth a read. But basically, he's of the view that a slowing global economy, winding back of government spending will mean inflationary forces start to subside and economies will need support. So my view for some time has been that as we go into 2023-24, there is a much higher probability of loosening both fiscal and monetary policy, and that basically we're going to be slipping into a recession was essentially his.
But of course, that's the business cycle and the economic cycle to the extent that we are where we are now. Everyone's predicting a recession. What happens in recessions? Rates start to get cut. So of course, if that's going to happen, this is a consequence of that event, is it not?
It's usually the end outcome. I mean, right? So most of the data. So the part of the issue is that central banks and reserve banks are using data that's 1, 2, 3 months old, trying to make decisions for 6 or 7 months down the track. So, I mean, you've got a clear data gulf there, and you're going to get it wrong. You're going to go too far at some point, and if not most of the time. Something that Victor did mention and kind of point out a couple of times is the neutral rate. The neutral rate of interest rates is really, really important. So that's the rate at which...
what is that rate?
So that's, and no one knows what that rate actually is in terms of the number, but effectively it's the interest rate where policy is not adding to growth nor detracting from growth. It's the happy medium, if you like. And no one knows it. It's a theoretical rate, I think, in my view, because I don't know if it exists for an entire economy. So the neutral rate for WA might be higher than what it is for Victoria. Sure.
But that's why there's a central bank trying to manage all that. What's your gut feel? Where do you think central interest rates cap out at?
I think in Australia it's probably lower than the US is my gut feel. He in the article was noting that financial markets are expecting 2.75% in a year's time in the US and 3.5%.
Yeah, that's what I saw that.
Australia.
That's what the market's pricing in.
Yeah, I honestly I struggle to see that. I think if we got to 2.5 to 3 at official rates before they start to be cut. I can't see them going beyond 3. So what would that, mortgage rates of 5?
Something like that.
I think that's probably pushing it. In the US, probably 3.5. Earlier in the year we were saying cash rate, yeah. Earlier in the year we were saying we couldn't see that rates going through the roof, up by whatever people were saying. It's starting to look like maybe they will. But yeah, they're certainly moving a bit more aggressively than I thought that they might.
It is hard to see the Reserve Bank cash rate at higher than where the US Federal Reserve cash rate sitting, but market's pricing in 275 for the US, 3.5 here for Australia. And look, maybe the market will be right. Maybe they might be right at some point in time, momentarily.
And that's for 12 months from now.
12 months from now.
That's those targets. So where are we at? 0.35. So they've got to go up
315 points from here.
I don't know. I don't see it happening.
And sure, if that's a reflection of a stronger economy, and that's a reflection of low jobs, spending, and so forth, then market's strong. Sure, maybe, but then I think it'll turn pretty quickly.
Yeah, I think it will too. I think it'll be a sharp rise and
that's my gut feel.
Decent fall. Yeah.
That's my armchair economist coming out.
You heard it here first. So another article we found on Bloomberg was from JP Morgan. Basically, and I'll summarize this in just a very few words. So the stock market's become overwhelmed. There's an overwhelming chance of a rebound, given that the market's just gone too far. And interestingly, he was basing this off the American Association of Individual Investors.
Oh yeah, the AII, which we've been
graph you showed last week and the week before, just showing we're at pessimistic levels, and the market has gone to the pessimism, the bearish sentiment has just gone too far.
Have you brought this chart up? Well, why don't we just, because that's what you're talking about now.
So bring the chart up. Yeah. So there's so this is the opposite. So last week we looked at the bullish view. Yeah. This is the bearish view. So it's the invert of that last one. So, not since 2009, I think it was March 2009, have we had bearish levels at where we're at right now. And I wouldn't be surprised to see that get worse. I wouldn't be surprised to see us hit 70.
So what the peak was during the GFC?
Yeah. And just because I think rates will continue to go up for a little bit. And, if some major companies have come out and missed earnings, they've grown earnings and they've done okay, but they've missed the expectations. I think maybe the expectations are too high. We just saw the PE in the chart you brought up, and it's still at 17, 18
times. Yeah.
So it's not cheap. There's still certainly room for a bit of a decline, I think. And, ultimately that's just a buying opportunity. So if you've got your powder, keep it dry for a little bit maybe. And
well, according to Chris Joy,
yes,
the market's going to fall another 20 to 35% from here.
And that's from here, not from, far out. I mean...
Is Chris Joy like a perma bear?
Maybe. I don't see.
Is he like a Rubini, just a neural Rubini who's like just constantly bearish on everything's doom and gloom. There's nothing positive in the world.
Nothing happy. Like smile, man.
I haven't seen Chris Joy smile.
I haven't. I'm trying to think of...
Massive shout out to Chris Joy. Great publicity on Livewire. Coolabara. Yep.
I'm just trying to think of an article that I've read from him where he is optimistic and positive. I'm sure he's got some. Maybe we should have a look just to balance the point. But
Livewire, can you please categorize Chris Joy's articles into bullish, bearish, so we can just sift through that?
Yeah. Look. So I mean, but it's the same thing. That when markets are falling, everyone's bearish, and when they're rising, everyone's bullish.
That's true.
So everyone's just piling on at the moment.
That's true.
And that just creates opportunities, as Warren Buffett spoke about last weekend.
But this is a time where you see and hear people coming out talking about what investors should have done.
Yeah.
And so this is when the hindsight experts come out and talk about what you should have done at the back end of last year, what you should have rotated to, what sector, what stocks. Like, we all know this. Why don't you come and tell us where we should be investing our money now for the next 6 to 12 months and when we should be doing that?
And this is the time everyone comes out and goes, 6 months ago I said we're going to fall.
Yeah, everyone said.
You know, was it Barry Ridoltz?
Ridoltz had an, yeah.
Yeah, that was awesome.
Yeah, it was he was on Bloomberg. That was, maybe we'll try and find that and share that in the notes if we can. Look, let's continue. There is the market is being massacred, literally. It doesn't appear that way on the surface, though. So if you look at just the S&P 500 or the ASX 300, even the Nasdaq, I don't think truly reflects what is going on under the bonnet if you lift it up and have a look. Interestingly, I want to get this chart up here, which was from Statista that was published post Apple's earnings. And interestingly, I mean, we talked about this before, whereby market declines are happening, I think, because of investor pessimism, more so than the fact that company earnings are coming out with that might be bearish, or they're missing expectations, or their growth is falling, or whatever the case may be. But if you have a look at this chart now, the light blue line is 2021, the dark green line is 2022, one year following, and you see revenue up for iPhone up 5.5%. Interestingly, their services business up 17% growth on 3 months ending for the March quarter. You've got Mac sales up 15%. The interesting one for me was the wearables and accessories like watches and earbuds and things like that. That's growing dramatically. Like, I didn't realize how big of a
segment that is.
Yeah,
it's huge. I mean, it's almost as big as Mac. You know,
crazy.
10.4 to 8.8 billion, but still, I mean, it's huge.
But the other one was iPads, down 2.1% 3 months ending 2022 versus 2021. But the point that I'm trying to make here is that I just don't know if this decline in markets, whether there's a tale of two worlds, so to speak, whereby you've got the massive companies and you've got the smaller companies within the market.
Yep.
And I'm just wondering whether this tech wreck has already happened. I mean, you brought up this chart as well, which will get this one up now. Do you want to chat about this one?
Yeah, look, it's just the big five, maybe we'll call them, the big five tech companies, and their price declines from their 12-month high. So Apple's down 13.5%, Microsoft 19%, Alphabet, which is Google, 23%, Amazon 33%, and Meta, which is Facebook, 47%.
What's not in there is
April
Netflix.
29th.
72%.
Conveniently. And that's as April 29th.
I think it'll make everyone else look good because Netflix 72.
That's right. It detracts from their point. But yeah, I mean, these companies are still making massive money. Even, Facebook, they had a bit of a misstep, but they still come out with, some decent growth. Amazon, cost pressures. Alphabet, Microsoft, and Apple for me are the three to watch. I think Alphabet and Microsoft, they're just slowly taking over the world.
But the point we made a few weeks back, that these companies are not just one trick ponies.
No.
We saw before, like with Apple, with their iPhone services, Mac, wearables and accessories. I don't know why people aren't buying iPads anymore, but
they are.
Well,
$7.6 billion worth.
Well, slightly less than last year, but yeah, that's
yeah, but you're right. I mean, Amazon. Everyone thinks Amazon is online retail shopping delivery, but AWS is an enormous monster.
We talked about that early in the year.
Yeah,
that's what's holding up,
and they're growing at enormous rates. Alphabet, same deal. Their web services business, Microsoft Azure web services business. I mean, they're huge, and that's just a small part. Like Apple, I'll mention this later, but the rumored car products. So they've got money to go into these new segments that they're not already in, which has just got huge growth and opportunity for them, and everyone's focused on the now.
Yeah, and let's talk about that a little bit more. Michael Batnick put up these charts, which I'll get the first one up in a second, whereby he was looking at the NASDAQ 100 from 2000 to 2021 during the tech wreck, and using today's ARC, which is Cathie Wood's technology disruption ETF in the US, as a proxy for that of the NASDAQ back in 2000, 2001. So I'll just get this chart up now. And what it's showing is the black line is the NASDAQ from its peak to its 12 months out, from 2000 to 2001. And he's overlaid that with the ARK ETF from its peak to the same time out now. And what's interesting to see out of here, it follows a very similar trajectory. And so even people talk about we're going to see a tech rec-like decline in the NASDAQ. Maybe it's not going to be in the NASDAQ. Maybe we've already seen that tech rec and we've seen it in and amongst constituents that are less dominating. And because of the fact that we've got the likes of Microsoft and Amazon and Google and Apple and so forth, which although they look like they're just 5 companies, if you lift the bonnet up, and they've got 5 or 6 companies within them, you multiply that by 5, 6, 7, all of a sudden you've got 35, 40 companies that they effectively represent. And the sheer weight of that is causing some sort of imbalance between the entire market. So maybe we have already seen this tech wreck. We talked about before, Netflix is down 72% from its highs in December 2021.
Yep.
Like how much more do you want that thing to decline right now?
Yeah, that's right.
Meta's down 47%. I think that was the number you mentioned. So we've got Amazon, we've got Meta, we've got Netflix, we've talked about Peloton a number of times.
DocuSign,
Zoom.
So many.
And so through that universe, we have seen a tech wreck. And interestingly, the decline in ARK from the top is worse than what the NASDAQ 100 experienced over the same number of days.
Yep.
Back from its high in March 2000, which is crazy. So if you think about tech wreck, this is actually worse than the 2000, 2001 tech wreck.
All I'll say to that, though, is I don't know how ARK's weighted, but I imagine they don't have a lot in some of those top 5 companies. And I don't know. I've never looked at them. My impression would be they've got more of the Teslas, which is a big, massively profitable company, but they're more of the future disruptors as opposed to Apple and those companies that are big right now. Maybe I'm wrong.
But I think that's Cathie Wood's point, that these are the companies that are... But these are the companies that were up...
Back then, they were those future disruptors.
Well, maybe they will continue to be the future disruptors, but the fact that they've... these guys are... They were up 3, 4, 5, 6, 800% during the pandemic.
Yeah.
And it seems really hard to see some of those companies coming back to those levels again. And I'll bring this second chart up now, which looks at the green one, the black one, colorblind, the black line, which is the NASDAQ 100 from peak to trough. And you can see ARK, so we're halfway. Is it halfway?
Pretty close.
Pretty halfway. So we've got another potentially couple of years to go.
Another year or so. Fun.
And so what Michael's saying is and it's a good point he raises. So if ARK's down 70% and you've got the NASDAQ 100 down 82%, the difference between the 60% and the 82% is not in fact 22%, or sorry, the 70% to the, let me just go back. No, 60% in the previous chart to 82%. It's not a 22% decline. It's in fact another 56% decline for it to get from down 60 to down 82. So it's you know what I'm saying with that.
Yep.
And so if we're down 70% on ARK, which effectively represents today's tech wreck, it's starting to fish down towards those bottoms. I reckon if we compare it to the NASDAQ 100 of the 2000 2002 era. Yep. I mean, I don't know. I'm not saying that's affected the bottom, but. Yeah, look, I'm wondering how much more is there to go. And the real point that I'm just trying to make is that I think that we do have a tale of two cities where we've got a universe of stocks that have been crucified and we have seen a tech wreck, and then the others that we just haven't, because they're actually making a ton of money. Their earnings continue to grow. But interestingly, you look at Netflix, their subscribership over the last 5 years has doubled.
Yeah. I mean, they lost, we talked about last week, 200,000. And most of that, or all of that, was accounted for by Russia. The expectations are going to lose a few more, but even 12 months ago, they're still going to have substantially higher number of subscribers, and they've pushed their prices up. I've just looked up ARK's top holdings. Tesla's number 1, Roku, interesting. Zoom, Coinbase, Block, Teladoc, Unity. So they are very future looking. They're not in those big Google, Amazon, all the rest of it. But I guess Google, Amazon, they were these companies, 20 odd years ago.
And that's why we saw that growth. And look, maybe Cathie's right. And you can actually start to see people are still ploughing money into the ARK ETF. So people are still buying this stuff.
Yeah.
So it's not like the tech wreck where everyone just sold out and these companies literally just blew up.
No,
people
are
still buying these stocks.
And a lot of these companies are profitable. I mean, Zoom might be down 40, 50%, but man, they make massive money. Huge amounts of money. So you're right. They're not like, was it pets.com or something was the famous one in the States that they basically had no business. I don't know if it was pets.com, but it was something like that. And they just went belly up straight away. So back then valuations were based on purely, just fantasy. At least these companies have real businesses. They're making real money.
Sure.
So at some point
not
they
all of them are like that though. But I don't disagree with you. Maybe it's just going to take a long time to come back. Maybe not. Do you want to add anything on to that? Because I want to talk a bit more about the Cathie Wood.
No, mate. Go for it.
So there was an article not that long ago which said Cathie Wood's doing God's work, and talking about the tech wreck. I'll just bring this tweet up by Cathie Wood where she talks about. She retweets Elon Musk, who talks about passive funds, and Cathie, quote, passive funds prevented many investors from enjoying a 400-fold appreciation in Tesla from a $1.6 billion market cap at its IPO in June 2010 to approximately $650 billion when it entered the S&P 500 10 years later in 2020. She then goes on to say, according to ARK's research, most broad-based passive funds are short disruptive innovation at a time when the global economy is undergoing the largest technological transformation in history. Haven't we already gone through the biggest transformation in history? Sure. She then goes on to say, in my view, history will deem the accelerated shift towards passive funds during the last 20 years as a massive misallocation of capital.
That's interesting.
It is interesting. So let's have a look at this. Top 20 positions of ARK. In the top 20. There are only two stocks that are up. Tesla is up 526 million during that time. The other one is PD. Was it Pager up? PagerDuty. So they're a US cloud computing company. Everything else is down.
Is that for the last 12 months?
That's a good question. I don't know what the answer is to that.
Yep.
I would say, I'd probably say since inception. And so the question for Cathie is, if you talk about misallocation of capital and your fund's down, what do we say? 60%?
Since the peak.
70%? Yeah, well, since the peak, that's down 70% since the peak. I just wonder who's misallocating capital here.
Oh, look out. There's a challenge.
Cathie came out in the back end of 2020 and was suggesting that the disruptive companies or the ARK ETF will perform over the following 5 years at a compound annual rate of growth, or a CAGR, at 40% per annum. Now, as that declines, I can see why she would go out further and say that her fund or the ARK ETF is due to return 50% per annum, because as the number declines, the expected return should go up, right? So
Absolutely.
I totally get that. So I read some numbers, right? I just want to get this up for me so I can just quote you some numbers. Some guy crunched the numbers on what the probability is to generate a 40% return and a 50% return. So let me just read this out to you guys, and I'm curious to get your point of view on this, Matt. So looking back in the S&P 500 over the last 5 years, just 33 current S&P 500 companies returned 40% or more. Only 33. So if picked at random, do you know what the probability is of picking a 40% returning company? It's 1 in 15 chance. So you've got a 6.66% chance of selecting one of the winners.
So you're saying there's a chance?
100%. There's always a chance, but also don't forget that their universe is much greater than that of the S&P 500. So all of a sudden, your 6.6 becomes like
massive
3% chance or something like that. And then they go on to then work out that if you had to have joint probabilities of independent variables, so I think the ARC ETF has about 45 stocks. So then in order to have those 45 stocks generating at a portfolio level a 40% annual growth rate over the following 5 years, you have a less than 1 in 38,000 chance of selecting just even 3 mega winners.
Wow.
In order for your portfolio to generate that level of return.
Yeah.
They go on to say, if we extend this thought experiment beyond 5 years and say, let's do it over a 10-year period, do you know the probabilities of identifying a 10-year 40% compounder?
Got to be lower, right?
Falls just under 1%. There've only been 5 companies in the S&P 500 that have been able to do that. Tesla, one of them.
Uh-huh.
And interestingly, I'd be curious to see if the ARC fund didn't have Tesla, I wonder what the decline would have been. It would have been
brutal. Absolutely brutal.
NVIDIA, Dexcom, Netflix, Monolithic Power Systems, who I don't know who they are. But so there've only been 5 companies that have been able to do that. So the probability is really, really low.
Exceedingly low.
The guy's titled his article "Wacky Cathie." We'll put the article in the notes if you want to have a look at it. It's really interesting though from a pure statistical point of view as to what the odds of that happening are.
Yeah.
But I don't know, maybe ploughing your core allocation to your portfolio into such an ETF or funds may not be the wisest.
It may not be, but I've just had a look at the ARC Innovation ETF since inception, which was October 2014. It's returned 134%.
Per annum?
No,
or
just absolute. That's the return. So it started at $20.38, peaked at 180 odd, 60 odd, 152-ish, 160. Is now down at 47. So almost back where you started. Look, I think, I don't know. It doesn't matter what you say. Look, good on her for talking her own book. I mean, no one else is, right? She was the poster child during the good times. She's getting belted now.
What do they say? Live by the sword, die by the sword.
Absolutely, man. Absolutely. Look, some of those companies in there I know and I really, really like. But yeah, there's plenty of research to say that the long-term performance isn't so much about your winners, it's about avoiding the losers. And that's
easy.
That's the hardest thing, right? So good luck, Cathie, is all I'll say. Well, but we'll watch. We'll watch your journey.
But I think it goes back to how investors should think about investing their own capital and how they should be allocating their own capital. Talking about misallocation of capital over the next 20 years' time will tell. I don't know. We'll have to wait 20 years to find out.
If I could guarantee that the fund would stick around, would you have a punt?
I'd have a punt if you guaranteed the fund stuck around.
Yeah.
But we talked about this 2 weeks ago. The probability of the fund sticking around is 45%.
Well, apparently it's getting lower and lower as the months go by. So performance is worse.
So I think investors need to look beyond the headlines and beyond the narratives and just look at the friggin' odds, man. Look at the probabilities and start to make decisions based on probabilistic outcomes rather than absolute outcomes. And I think investors can have a much, I don't know, I'd say it's a much smoother ride, but probably one that's more thoughtful maybe. Anyway.
Yeah, look at, I don't know. Look, time will tell. We'll see where she is in a year's time.
Do you want to add anything to that, or we'll move to director's cuts?
I think we've exhausted that one.
All right.
All right, director's cuts. I'll kick it off.
Dead horse. Is that the saying?
Yeah,
beating a dead
horse.
So, look, we've talked about the RBA and global supply chains. Let's get this chart up. It's again from Statista, which is an infographic showing cargo ships and tankers in and around Shanghai ports. And to me, I mean, I'm not a logistics expert and I'm not an expert on cargo ships and whatnot, but to me, this looks clogged up.
Far out.
What do you think?
Holy shit.
But
how?
I don't know.
How do they get
on.
so many ships?
How do they get around each other?
Far out.
Look at those.
They're on top of each other. I mean, right in Shanghai in that port there. I mean, they're just freaking on top of each other.
It's the Monash Freeway.
Is it a channel in there?
I don't know. I was wondering whether that's a channel. I suspect it is. And so for this reason, I think this inflation topic is going to be around for a little while, and this is not going to help the cause. I just wonder, another 25 basis point rise by the RBA is not going to make these ships move faster.
No.
Is it?
Nope, not at all.
But it should start to slow
the demand side of it.
Yes.
Sure.
But whether or not this stuff is already sold.
Well, and the other thing I guess to note is it's certainly been ordered, so Maya have already ordered their stuff. They're waiting for it.
Correct.
By the time it gets here and in the store and on the shelves, could demand have fallen that they're just going to have to do wholesale, sales. I don't know. I mean, logistics is difficult. This is why people in logistics make so much goddamn money. But, right now to navigate that would be just a friggin' nightmare.
We talked about this a number of weeks ago in one of the episodes where the likes of TK Maxx, for example, in Australia and I don't know, whatever they are overseas, where they're seeing a massive, this is good for business for them because by the time these cargo ships arrive, the season's over. And like the likes of a Maya or whoever in the US or the UK can't sell winter clothing in summer anymore. And so it goes to these discount warehouses, discount retailers, and it's really good for business for them.
Yeah.
So maybe this is a continuation of that. I don't know, but this does not look pretty right now. And in their pursuit of COVID zero, these ships don't look like they're moving anytime soon.
Yeah, and it doesn't help that I was listening to someone the other day saying that they're too proud to take on the Western vaccines and therefore their vaccines aren't as effective, so that's not getting better anytime soon. One thing I just wanted to note, and this is something I find fascinating and I really can't wait till it actually happens, if it ever does, and that is Apple and the Apple car. This has been talked about for, 7 or 8 years, and apparently there's been lots of setbacks and lots of people leaving, but they've just hired a long-time Ford executive, Desi, not even going to attempt it, whatever his surname is, but Desi helped lead the safety efforts and vehicle engineering for 3 decades at Ford. So you look at that and they go, well, clearly they're serious, right? There's something happening in the background there.
Or Ford's just gotten rid of him because he's
or Ford is
in an old world.
We don't need you anymore. But this has been talked about for so long. I think Alphabet looked to buy Tesla when Tesla were basically on their knees, and Musk had conversations, and Alphabet kind of went, nah, it's not for us. I mean, huge miss in hindsight, right? But Apple have got the money to fund it. I mean, they've just got so much money. It's a huge emerging product class. I mean, I can see them making a real go of it, but I don't know. It's just really interesting to think that Apple might come out with a car.
When we were up in Queensland a couple of weeks ago, there was in one of the streets in this little pocket. There's a driverless bus. It's like a mini van, and it fits like 6 or 10 people or something like that. And it's got this pre-programmed route that it just takes you on. It's automated.
It's not on rails or anything. It's an actual.
It's an actual I call it a bus. It's making it sound a lot bigger than it is.
It's like a van.
It's like a little van.
Yeah.
But it looks quite sort of cartoony, if you like.
Okay.
It's not like a.
There's no one sitting in the front.
No.
No one at all.
It just parks itself there.
That's cool.
And so the door's open. You go in.
Did you get on?
No, we didn't.
Oh man.
No, because we were on the Quackaduck, and it was
Right. Well, everyone keeps saying no. Everyone. So many people are so skeptical of driverless cars. I mean, I think they're going to happen.
I'd jump in one.
And I think they're going to happen sooner than most people think.
I'd jump in one. 100%.
Yeah, so would I.
Cool tips and recommendations. What do you got for us this week?
So what I've got this week is a show that's been around for a while. It's on SBS called Alone. I don't think I've reviewed it before.
SBS?
Yeah.
I don't even know if I get
that's the
free
channel
air.
at the end of the dial. Anyway, so Alone, the concept
SBS
is...
were known for world movies.
Yeah, and
They still are?
soccer, football.
Oh, that's true.
They used to. Now they've lost it. Anyway, so they've got Alone. There's, I think, 7 seasons. There's Alone Norway, Alone Sweden. There's a whole bunch of them now. So the concept is you send 10 people out to the wilderness.
Oh, this is like
like a competition.
It's real life.
It's real life, yeah. And they have a list that they can only choose 10 items from. You know, like a flint to start a fire, or an axe, or like this is what you get to choose from. Sounds so I'm watching season Minecraft. 7 at the moment. A little bit. So the first couple of seasons, maybe 3, they went to Vancouver Island off Vancouver in Canada. The highest per kilometre population of black bears and wolves and all sorts of stuff in the world. And I mean, this stuff is crazy. So like these guys arrive on day 1, and so it's funny. They get the before story. So this dude was a copper in. One guy was a copper in I don't know, Detroit or somewhere. Oh, I'm a cop, blah, blah, blah. He lasted like 2 hours. He saw a bear, saw another one. He's like, I'm out.
Oh, really?
I'm done. I don't have a gun. I'm done. Yeah, they've got, just got a tent. Not even a tent, just a bit of whatever material. And there's a bear literally on the other side, and you're lying there trying to sleep, and you can hear this bear breathing the other side of this bit of material. I mean, that would freak the hell out of me. But the one I'm watching now, they're in the Arctic Circle, so northern Canada, if you like.
Right.
And the snow's about to set in. And so they're all like... Okay.
What are these people choosing? Like, can you choose like jackets and tents, or is that like...
Jackets is fine. The pretty common is like a net for fishing. An axe for cutting down trees and building a house. Like these people are building log houses. It's just insane. A flint to start fire. You get pots and pans.
Do you have to...
They make their own beds. It's crazy.
And how long do they have to... Is it like a longest last?
Yeah, longest last. So in the first season, I think the dude lasted like 50, 60 odd days.
Wow, that's
pretty good,
2 months.
Right?
Pretty good.
The season I'm watching now, if they make it 100 days, they win $1 million.
Oh,
so they're all like, all right, I'm here for 100 days. And they're building, they've got like a cabin or a little house, and they're building a chimney. So they've got a fire in the house. They build a chimney so the house doesn't fill with smoke. I say house. It's like a cabin thing. But these guys are so creative. You'd have making chairs out of just sticks, and they're just sitting down.
Well, how do you think people have evolved, man?
I know, but we've become so comfortable. But these guys are like survivalists. This is what they do anyway. And some of them talking about, from the age of 7, I used to go out in the woods and kill rabbits and skin them and gut them and eat them and like far out. Man, in theory it'd be fun.
No. Presumably there's no vegans on the show.
No. The bears are stealing all the berries, so you got to choose wisely. Anyway, so Alone, SBS, tons of seasons, really, really interesting. And if you don't like watching animals being skinned, probably
definitely not one for.
Pretty fun.
Not one for those.
What do you got?
Do the villagers come out at night time, and so you got to go underground?
Bears and wolves,
the bears and wolves,
and pumas. Like you can see, so these guys have to carry their own camera equipment, so they are literally by themselves.
Why do they have to? How do they charge these things? Do the producers of the show come and give them a new battery? I
don't know. I think there's medical checkups every couple of weeks.
Okay,
but they've all got sat phones, so they're like, "There's a bear outside my cabin. Come and get me. I feel like I'm going to die." And so the emergency dudes kind of rocketed in helicopters or boats or whatever.
100 days, $1 million. I'd give it a crack.
Yeah?
Yeah.
You wouldn't last 10 days.
Why?
I don't know. 'Cause you're vegan, man. What are you going to eat?
Plants.
Nah. You'd poison yourself. I reckon I'd last longer than you. We should do that.
No, you would get scared of the night time. You'd get scared of the night time, have nightmares.
That's all good.
I've got a pretty, it might sound pretty boring of me, but the thing that I've been watching over the last week is the Berkshire Hathaway annual shareholders meeting. I'm sorry, you're watching Alone SBS shows. I'm watching shareholder meetings. The whole thing goes for 6 hours. I sort of, fast forward, rewind. And look, Warren Buffett and Charlie Munger, I don't know how many more of these they're going to be doing. But man, these guys are like in their 90s, and just the wisdom, the gold nuggets that you get out of these guys, and the questions that are being asked by shareholders and the audience and so forth, to listen and hear the responses from these two is absolutely humbling.
Yeah.
And what it made me realise is that our industry and people in our industry and we overcomplicate things so much. And I think even from an investor's perspective and a client's perspective, it's not overly complex.
No.
It's so basic.
Yep.
But I think in this pursuit of trying to make ourselves look smarter or more important or more intelligent, we overcomplicate things. And the numbers show the more you overcomplicate things, the worse your performance is.
Yeah. Yeah.
But it's people, I think human beings have this pursuit or this desire of control, and I want to make these decisions and I want to feel in control because I think I can do better than everybody else. Yeah, history's not on your side.
No, absolutely.
On that one.
I love these guys. I just love that they sit there and just say, all right, ask us whatever question you want, and we're going to sit here all day. You know, so many CEOs need to take a leaf from their book.
They're there. It's over 6 hours.
Yeah, I know. They're sitting up on stage just answering questions. I didn't realize they were both born in Omaha, Nebraska. I didn't realize Charlie was.
Oh, I didn't know Charlie was.
He's 98.
Yeah, that's right, 98.
And he's sitting up there eating his C's candy.
Yeah, he's eating nuts and drinking Coke.
Just love it. It's so awesome.
But I think that the point is there's so much that we can learn. And I learn, and it grounds me every single time you read the annual shareholder letter, you watch the annual shareholders meeting. And they talk about market timing, they talk about the economy, they talk about trying to pick stocks and just how, and they don't purport to know anything more than the market.
No.
Yet headlines and the media make it out as if they're the greatest stock pickers of all time. They admit that that's not what they do.
Yeah. They buy businesses when they're
fascinating.
Valued with a moat and got good earnings outlook. That's
well, beyond that, I think it's genuine looking. You just said Charlie Munger's 98. So it's not like this happened in 2 years or in the ARK ETF happens in 3 years' time.
Yep.
This thing's been happening for the last 50, 60 years.
Like literally 60 years.
That's the compounding effect, right?
Yeah, yeah. Well, it's interesting. I think that acquisition they made a little while ago, Warren made the comment that he'd been watching it for 20 years.
Correct.
Like, that's patience. I mean, now's the right time. Why is now? I don't know why now's the right time, but now was the time for him to jump in and buy it. It's just incredible. No, I always make a point to listen and read that stuff.
Sorry, nothing interesting, but I'm certainly learning a lot there. Anything else you want to add, or we're good?
No, I think we've banged on enough.
All right, let's wrap up. info@baharianwealth.com.au. If you have any questions or suggestions or anything, hit us up.
Hit the like button.
Hit the subscribe button.
Subscribe. That's it.
We've clicked that 100, and we're hovering around like 103 subscribers on YouTube. Let's wrap up, and we'll see you next week.
All right, guys. Cheers.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.